Hello and welcome to QANTM Valuations FAST30 Webinar Series. Our goal is to share practical ways to use IP and other intangible assets to optimize deal outcomes, growth, and value. For those new to QANTM Valuations, we're a specialist valuation firm focused on IP and intangible assets, helping companies and advisors articulate and defend intangible value for transactions, governance, and tax-related needs. A quick housekeeping note before we begin. Today's session is being recorded and we'll share the replay link and the slides with all registrants after the webinar. Please drop your questions into the Q&A panel as we go. We'll cover them at the end. Today's topic is on valuation of data. Data is everywhere, but valuing it reliably is still one of the most misunderstood areas of intangible asset valuation. We're delighted to be joined by Nicolas Konialidis, Director Asia at the International Valuation Standards Council, alongside Tim Heberden, Managing Principal Valuations at QANTM Valuations. We're proud to be a member of IVSC, reflecting our continued commitment to the highest standards of professionalism, ethics, and transparency in valuation practice. With that, I'll hand over to Nicolas and Tim.
Great. Thank you very much, Jack. Well, you'll be pleased to know that the contents are aligned with the invitation, just some refinements in the sequencing and the grouping. And in addition to different voices, the branding on each slide will let you know whether you're getting my practitioner's input or Nick's perspective, which is where we'll start.
Yes, thank you, Tim, and it's great to see everyone. I just want to give a bit of context to this forthcoming presentation. Just as a reminder, the IVS International Valuation Standards are freely available, so if you don't have a copy, please don't hesitate to reach out. But these are principles-based standards that apply to all the valuations and for all intended uses, and we'll get back to that. The IVSC also publishes perspective papers, and these are not authoritative, but they seek to inform the public debate. In fact, one of the sources for the material for this webinar is a perspective paper that the IVSC published about a year ago, a little over a year ago, around the valuation of data. I should say also that the views represented in this presentation are my own, and they do not necessarily represent those of the council. And I'm making it very clear when I quote the standards themselves. This is a busy time for the valuation standards. We have opened an exposure draft consultation, and it runs until the 30th of April 2026. And so all stakeholders, whether you're members or not, are invited to comment on the future of international valuation standards. And again, stakeholders don't only include valuers, they include policymakers, they include users of valuation, they include corporates, academics, and so on. So really, everyone is welcome to comment on these proposed standards. The standards are revised every 3 years, and what the main changes that we propose are new definitions in the glossary, an expansion of scope of work to include the use of ranges, which is a popular item, valuation models, and the use of AI and other technology. There's a new chapter, IVS 107, on quality controls, and finally, there are some refinements in the asset standards with more alignment in the general standards. And of course, there are quite some material changes, significant changes to IVS 210 around intangible assets. The perspective papers the perspective paper on data was the fifth in a series of perspective papers that ran from 2021 to 2024, and all of these papers are available. And you can see how we started with a perspective paper examining the issue around the recognition and measurement of intangible assets. We then went to examine human capital, brand value, the valuation of technology, data, which we'll talk about today. And finally, there's a series capstone that looks at customer-related assets, but also thinks about the future and how to deal with the valuation of intangible assets at a time when the financial reporting standards are themselves being changed.
Thanks, Nick. Well, the title of the webinar used "The data is the new oil," just to stress its importance. But we found a range of different reference points, and whilst they all seem to agree on the importance of the data, there's some confusion as to what it's replacing. And in addition to this descriptive disagreement, it's worth noting that the term data is used very loosely, covering anything from a dump of unsorted, neglected stuff to highly sophisticated databases yielding real-time insights. So that's something we'll go into in more detail later on. It's also interesting to note that that first quote from one of the founders of dunnhumby is over 20 years old. And dunnhumby was the firm that revolutionized the extraction of insights from consumer data for Tesco, the UK grocer. And it is consumer data which is often in the headlines. But as Jack said, data is just about everywhere. It covers the entire value chain, informing marketing, new product development, through manufacturing and logistics, and pretty much every aspect of operations. And data-driven insights span industries as diverse as mining, insurance, medtech, TMT, and energy. And some data is out-licensed, so it might generate direct revenue, but it's more frequently used internally to increase the efficiency and effectiveness of business functions. And this internally generated data is often a byproduct of economic activity. So the next and really crucial topic is the identification of data assets, and I'll pass back to Nick.
Yes, so let's take the problem from the other side, which is that a valuation always has an intended use. And in a way, the intended use conditions the contours of the asset that is being valued. Now, of course, I'll just mention a few of the intended uses of valuations. Financial reporting, of course, is one of the largest use cases, and of course, a valuation for the purposes of financial reporting has to comply with the applicable standards. There are valuations of intangible assets and IP in financial reporting, but there are also valuations of intangible assets and IP and data in other circumstances, such as M&A and transactions, tax and policy. There's an example, for instance, there are some particular allowances for the write-down of IP rights in Australia and in Singapore, for instance. But data can be valued for the purpose of lending, and finally, IP, IA, and data are often the object of disputes, and so the valuations that are used by expert witnesses also reference the IVS. So again, just the definition, the contours of the data asset really depends on the purpose and the intended use of the valuation. Now, going back to the standards and thinking about valuation in general and the valuation of data in particular, a valuation is never just a checklist. Valuation is always a number that emanates from the professional judgment of the person conducting the valuation within the constraints of the valuation, the intended use and other constraints that it may have. And so you clearly start with a valuation framework, the scope of work that defines what it is that you're doing, what it is that you're valuing, in particular if it's a data asset, the basis of value, the applicable basis of value. Are you looking for the market value? Are you looking for the fair value for the purposes of financial reporting? Or are you looking to come up with the investment value, which is the value of an asset to a specific owner, or perhaps a synergistic value, which is the value of an asset allowing for synergies? This context, this basis of value is very important in determining exactly how you will value the data assets, especially when its contours are ambiguous. Let's put it that way. Then you have data and input. So this is the data that goes into the into the valuation itself, as opposed to the data as the asset. And those, out of the data that is available, you choose the inputs that go into the valuation. You have to build a valuation model, and then you have to, of course, document and report everything, because it is through transparency that the intended user of the valuation will gain confidence in the actual number around the valuation of the asset. Now, again, I just want to emphasize that the inherent property of intangible assets is that they allow for a very wide dispersion in their value, right? Whereas perhaps a tangible asset, a building, a piece of machinery, sure, there is some possible variance in the value. When it comes to intangible assets, especially when its contours are, let's say, ambiguous or difficult to define, the range of possible outcomes is much bigger. In other words, the application of sound professional judgment is in a way more important when it comes to intangible assets and data, for instance, than it would be in other circumstances.
Great. Well, moving beyond whether it's the new oil or gold or air, one of my ranting topics is the lack of rigor that's often applied to identifying data and other intangible assets. I recognize that the purpose and the scope of evaluation informs the depth of assessment, but identification is an essential precursor to deciding if an asset is material and separable, to deciding if data is in the scope of a transaction or valuation, or whether it's worthy of investment. So I'm a fan of OECD transfer pricing guidelines requirements to identify intangible assets with specificity, and the statement that it's not sufficient to suggest that vaguely specified or undifferentiated intangibles have an effect on arm's length prices. Here's an example involving a fintech, which was in the revenue generating stage, where an intangible asset valuation was required for tax compliance. So our discovery process, the first step in describing the asset, included a range of different steps. So firstly, one requires a kind of discovery framework. So it's not just random questions or random investigation, but very structured, and that it covers the value chain. In this instance, we interviewed a lot of specialists, data specialists, tech specialists, operating and financial people, and also did a value mapping exercise, which I'll illustrate, as well as some performance benchmarking and references. The purpose of that is obviously on the right-hand side, identifying the drivers of value, customer acquisition, retention, price, and so on. But it's this middle bit which is so important on the identification. In this illustration, each one of those cogs represents an asset with the size it's important in generating current earnings. And yes, in this instance, the data platform was an extremely important asset, despite the fact that in a previous purchase price allocation, it hadn't been identified. It's also worth stressing that those cogs are looking at the current asset profile. They're not taking account of yet to be generated assets or new customers or the depletion and replenishment of a data asset. It's a snapshot at a point in time. And then, having identified the asset, it's working out exactly what it is. Now, in this instance, it was a well-constructed data platform, and those lighter colored boxes in the middle are the ones which are in fact data, both raw data and structured data, but then it's the darker colored boxes that make this an operating system that informs decision making. In some instances, your company or your client may only have some of the data pools which are yet to be yielding operating benefits. Those are often harder to identify. And in our fintech example, the data platform was very closely connected to a technology platform, which actually kind of grabbed particular algorithms and so on when required and used them in the platform. But for the purpose of this valuation, it was necessary to value the assets separately. There might be other applications where you bundle them as a kind of complementary combination of assets. Other points worth mentioning. Where there is this close interaction, one has to make sure that you avoid any overlap, that you avoid any double counting. And it's also, particularly for the lawyers in the audience, often important to drill down to the specific assets. So copyright can subsist in individual works within a database or within the compilation itself. Other aspects are not protected by copyright, but there might be confidential information or trade secrets. So let's have a look at some considerations in valuation, and it's probably time to get back to Nicolas.
Thank you. So the perspective paper really goes through how data creates value, and I think we have to go back to first principles. And the way that happens is because data raises profits by improving the decisions and optimizing the operations of any business. And this is particularly true since in many ways data gives you market power, and often the market structure is one of winner take most or winner take all. So you have a leverage effect there when it comes to the value of data. But that also means that by generating data, you're enabling yet more innovation and generating even more data, which again improves decision making and or reduces risk. On the other side of the ledger, you still have to think that the accumulation, the transformation, and the storage of data has a cost, and this has become very apparent in the current debate around the cost of electricity and the capital intensity of, for instance, data centers. But that's a whole other debate. And yet, in financial reporting specifically, data is seldom recognized as an asset. Now, there's another aspect whereby data is sometimes capitalized as a cost, but it doesn't appear as data. And there's one example here of a company that has now since then been absorbed, which was a PGS, which is a company that does seismic surveys for oil exploration. And so what they would do, or what they do, is that they sign a contract with one client that they do these surveys. They capitalize a cost, which incidentally is mostly the cost of fuel oil to run those ships up and down possible auction blocks, so they capitalize this. And in the case of PGS, they had about $300 million out of $2 billion of capitalized costs. This data is then sold, hopefully, multiple times to many bidders for the exploration block. In other words, this was data, but the data represented capitalized fuel oil burnt, and yet the data, ultimately its value came from reselling this data, some of the data, multiple times to possible clients, which they didn't really know about. And so you can see how through this example, data can be difficult to separate and how unstable its value is or can be. And so the approach here when it comes to the application of IVS is to recognize that there is no one approach or method that works for data in all circumstances. Again, we go back to the original point that I was making, is that the valuation of data always depends on the professional judgment of the person conducting the valuation. Finally, there's always talk about IA and about artificial intelligence, and on the right you can see three oil rigs, one from the early 70s, one from 2015, one in 2025. And this is perhaps how to think about data in this new world, which is that in the 1970s, when they started drilling oil offshore, they had a vague idea of reserves, and they thought that there would be a 20 to 30% recovery rate. And here we are 55 years later, and we have reserves that are multiples of what had originally been expected, and recovery rates that are hitting 80%. In other words, we don't know the value of the data. We don't know how much data we have, and we don't know how much we will be able to recover of the data and make this and where the value will come. This might be the right analogy when thinking about these new tools when it comes to the value of data. So I think we went through this example of PGS and the multi-client library. Interestingly, I'll just make one more point here, is that, and this is definitely not covered by the standards, but rather by experience. What we're seeing here is the importance of cohort-based data, which is really where you can strip out the value of marginal improvements or marginal worsenings in the value and the use of these of data as an asset.
Thanks, Nick, and I'm pleased we've established that it's definitely the new oil rather than gold or air. So assessing the characteristics of data assets. So it's a fairly obvious point that once you've found that there's an asset, you need to kick its tires as a precursor to valuation. And I said it's obvious, probably more so for second-hand cars, but in some instances, data assessments don't always get the attention that they deserve in valuation reports. So some of the things to look out for, we've indicated here some functional characteristics and benefits. What is the depth and the breadth of the data, the quality of the architecture, and the converse, any data debt or obsolescence, are there any legal restrictions in use? Then the example that Nick provided, how are those benefits achieved? Are they small incremental benefits? Are they restricted to one part in the value chain, or does the data actually enhance a range of decisions? How much commercial evidence is there on that performance uplift? And does it play out in an attractive market? Obviously, then we get the replication complexity, and the economic life of the asset, that kind of rareness and durability are vital. And then, of course, the risk characteristics of the asset. How well can you ring fence it? What is the risk of inadvertent disclosure? And often, if the asset has not yet been fully commercialized, there's a risk that it won't work or won't yield the benefits that you hope. Within Quantum, we have a data grading tool which takes a whole range of measures such as that and more, and then aggregates them up into a profile under these different attributes, and also gives a high-level grading score, and that then informs valuation assumptions. And yes, once we've kicked the tires, then it's time to do the valuation. And as Nicolas said, there's not one silver bullet. Here we've indicated, and obviously the right source here is IVS, identifying 3 different valuation approaches. The market approach, is easier for real estate than it is for data assets, just because there's more data, more transactions publicly available, and easier to benchmark the data. So there are some instances where data is sold and one can get reference points, but it's not often applicable. Then the cost approach and replacement cost method can be useful for replicable data assets, where there's enough information regarding the collection time, cost, and probability of success of building an equivalent data asset. The income approach is applied where it's possible to estimate the earnings impact reliably, and also its useful life. And within the income approach, one might use with and without method relief from royalty, or a kind of residual earnings approach. And in some instances, it's appropriate to use more than one methodology. We'll just look at a couple of key inputs to the income assumption, to the income approach, and the first one being data earnings. So if we get back to our fintech example, there wasn't one kind of definitive or silver bullet study to measure the earnings contribution that the data platform made but there were a variety of useful quantitative reference points, namely a third-party study of the estimated benefits that the fintech's own customers got from its data. Secondly, internally, the observed benefits to the data owner. And we had a few different ways of doing that. One is, as this was both the tech and the data platform strengthened, key profit measures improved. It was also possible in different markets where there was the same tech platform but different data histories of identifying the differential in those same profit performance measures. And also a really interesting example where the data platform was down for a pretty short length of time, and the performance, particularly the risk management, declined immediately. The third reference point was benchmarking. We were able to look at price premiums relative to competitors. We did search for purchase price allocations, but there were no useful examples in that case. And we did a search of royalty databases. Now, that is quite tough in data fields. And what we had to do is analyze very closely the descriptions of assets. So some were clearly tech and data assets combined, some were standalone tech without much data, and others data assets. So we were able to get an understanding of the royalty landscape, and then our own value mapping and looking at profit split analysis. And on that point, I always find profit split analysis comforting, even if it's only used as a cross-check. So along with the value mapping assessment, it lets you ensure that your estimate of data earnings is commensurate with its commercial importance, that you've left room for a reasonable return on all of the other assets and haven't overestimated the importance of data. And this really just shows that kind of triangulation where one brings together both the quantitative and the qualitative assessment to come up with a defensible assumption on the earnings of the data. And that could feed into different mechanisms. It could feed into a relief from royalty or a with and without valuation. Another tricky assumption is the economic life of the data and the decay of its utility within that period. And that can vary hugely for different types of data assets. So we'd typically conduct a search of published research and prior transactions. Once again, interviews with clients, particularly the data scientists, but also operational specialists who are kind of getting the benefit of the data. And in some instances, one finds examples of where data in a particular jurisdictional market wasn't replenished, and one's able to gauge the decline in performance. And here are a couple of examples. These are just illustrative, both of these showing over quarterly basis over a 2-year period, the bulk of the utility of those two data assets declines. But there are some examples. For instance, wind data in a specific location might have a much longer useful economic life. I won't go into too much detail on replacement cost, but I think a really obvious point is that the clarity, the accuracy of your definition of that data asset is of fundamental importance to calculating the direct replacement cost. And again, if one thinks of that data platform sitting alongside the tech platform, if you've just defined one or a subsection of one, that's going to be a lesser cost than if you've described a bigger asset. Another point is that some data assets require a long time to replicate. So the opportunity cost, if it's going to take you 2 years to collect that wind data, the opportunity cost in the delay is a really crucial assumption. So just one slide on this value-based management, but I recognize that some of you in corporates are more focused on amplifying the value of data assets rather than precise management. So we've spoken about data being a byproduct of operations. And we often find organizations that suspect they've got many pools of data, but that it's not well integrated and that it's poorly used. And the decision they want to make is whether to allocate resources to enhance that data asset. I was on a panel at Australian Institute of Company Directors panel on data last year, along with two very experienced non-executive directors. And it was interesting, their observations, that typically in the boardroom, data is seen through a risk lens. And they were stressing it's essential to have that more balanced outlook. It has to be included in discussions of strategy and operations. Again, they found in most of the boards they're sitting on, there wasn't much visibility of the size and shape and scale of the data assets, let alone any meaningful discussion. And in that discussion, in that panel, some interesting suggestions came out. Really, these are the non-exec probing questions to the executive team. What data assets do we have? Is it currently in a usable form? How do we use it? Do we have the right permissions and rights to use it? And are there any alternative applications? And then getting back to our data valuation toolkit, you can see how that plays out into those strategic decisions. But rather than a single, this is its value now, the interest is more on what could its value be if we conduct different strategies. So I know that Jack will be starting to get anxious on our FAST30 promise. So just a quick recap. I think these are pretty obvious. We've stressed the complexity of the asset. Nick's been very clear about the need to adhere to standards and best practice, which we 100% support. Other point is just the range of stakeholders who are interested and focused and asking questions about data and its current and potential value. And perhaps just a reminder that there are multiple triggers, I guess, where quantifying the value of your data is a useful or necessary thing. So Jack, I'll hand across to you.
Thanks, Nicolas and Tim. That was excellent, and keeping with the time as well. So we'll move into Q&A now. We have about 10 minutes for Q&A if you'd like to stick around for that. And if you haven't already, please drop your question into the Q&A panel. We already have a number of questions, so without further ado, we'll just get to them. We have a question from Legend Bureau. We're a non-profit organisation, industry funded, with a constitution that prevents sale. Is data valuation still important?
I'm happy to have a first stab and Nicolas join in. So yes, we have done data valuations for not-for-profits. It's very important, obviously, to describe or define what you mean by data. So sometimes the word is used quite broadly, and one might be looking to somehow quantify, possibly in financial terms, the benefits that you derive from the data, and whether that allows you to deliver more services or gain more funding, whatever the case might be. So it's still important, but one would have to be quite meticulous, I think, in scoping any sort of valuation.
To that, I would just add, apparently the Constitution prevents the sale of the data to a third party. It doesn't mean that, the organization itself could be the party or could be welcoming new members, which could require evaluation, and by not recognizing or by not dimensioning the data, you might be undervaluing the existing organization. the organization might need to make investments, and those investments need to be, again, dimensioned in some way. And so having a good grasp of the data asset, even if you can't sell the data, it might be important for the life of the entity itself. So again, I just go back to what I was originally saying. What is it that you need the valuation for? What's the intended use of the valuation, and what exactly are you valuing?
Fabulous, thank you. Next question from James Hart. Which valuation approach generally yields the highest valuation?
Well, firstly, I'll take a step back actually and say, which is the most appropriate given the type of the asset and the information that you've got. Now, if you've got a data asset where you can use different approaches and different methodologies, that's really a good thing. But we'd always use those, have them talking to each other, really. And as you go through it, you might find that one has more reliable data than the other. If one's coming out with a much bigger answer than the other, that straight away raises a whole lot of question marks. So you wouldn't sort of churn that out in a report. You'd go back to your inputs and assumptions, and it might be that there's a kind of assumption that needs refining. I'll throw it to Nick as well.
Again, we go back to the process. If you're able to document your process, have a robust process, and then document it, then you will be able to explain the choice of approach, the choice of method, the choice of the inputs from the available data, and then that's how you get the value conclusion that is appropriate for the intended use of the valuation.
Perhaps one other point, Jack, before you come in, that it gets back to the intended use, and for instance, OECD transfer pricing guidelines for hard-to-value intangibles, of which data is one. There's generally a preference for the income approach. But then again, as a valuer, we would, even if there's the user of the report has a preference for a particular approach, we'd want to make sure that that is the best approach. And again, ideally, we'd try and use more than one method.
Right. The next question comes from Varvara Mironova. It says, I represent the university. We were approached by business to provide scientific data, e.g. synthetic sequences, for training their AI models. Would it be feasible to evaluate this data?
Yes, and actually I did a project some years ago where a kind of government health body had data, and they were entering into an arrangement with a software provider which was going to use its data the health organization's data to train their algorithms. But the pro quo was that was going to be reflected in the cost of the health organization's use of the software platform. So really that was a situation where one placed a value on the data, but then kind of that informed a negotiation between the two parties. So the simple answer is yes.
All right. Next question, I think Jeremy Cohen has a two-part question. One is, when can, under Australian accounting law, one capitalise data? The second part to his question is, what is the usual discrepancy between accounting valuations and those valuations undertaken for capital raising or material financial events?
So I suppose the first thing, just a health warning, I'm kind of not an auditor or financial reporting specialist, but in terms of Australian accounting and international accounting regulations, certain development costs can be capitalized, generally not research costs. And if those capitalized costs are 100, but the market value of the asset is 1,000, it's still just the costs that are capitalized that can't be written up. In terms of sort of divergence between between different uses, it gets back to the valuation report being very clear about what the basis of value is, what the premise of the valuation is, and so on. And those can be consistent between applications, so there won't be differences in the valuation. There can be situations for a capital raise, for instance, where in addition to market value, you might look at investment value, or you might be asked to say, well, what is the upside of that value if a particular data, if a particular kind of milestone is reached. So there would be kind of different perspectives of value included in the same report. Nick, do you want to add on to that?
I would just add that sometimes, and again, outside the realm of financial reporting, I would just add that sometimes data is not data, as in the example that we went through in the perspective paper around the PGS and the seismic data, which was very clearly data. It was capitalized at cost, but it was not recorded as data on the balance sheet. So again, this is the beauty of valuation. It reveals sometimes, it reveals things in a different light.
And perhaps one add-on on that, you know, sometimes for financial reporting, there's less sort of focus on the specificity that tax requires. So, you know, there's certainly some examples where data gets left in goodwill or doesn't get split out. So I would argue if it does meet the definition of an identifiable intangible asset and is capable of valuation, it should be valued whether for financial reporting or tax. But it can be in those situations the balance sheet value has been established, and then one has to come in and drill a little bit deeper to do a valuation for capital gains tax or transfer pricing.
Excellent. Great perspectives. Next question comes from Juan Fonseca Argin. How can it be determined that the value is derived from the data itself and not merely from the software, as an example, as a whole? In that sense, would it be better approximation to value it as an integrated solution rather than as separate components, which can be more costly for valuation clients and often becomes a barrier for large segment of companies?
So it might be more appropriate to value it as a bundled asset, but again, it gets back to the purpose. So if for tax purposes you have to push down value to particular depreciable assets and non-depreciable assets, you know, whether it's copyright or trade secrets, for instance, then sometimes there has to be an apportionment. But it might be best to initially value the combined asset, and perhaps that's fine for one purpose. If you then need to slice and dice it a little more for another purpose, that can be a follow-up. But I take your point from a cost perspective. One doesn't want to sort of go into more granularity than is necessary or helpful.
Excellent. All right, we have one last question from Martin Burns. Is there an independent data integrity scale?
Not that I'm aware of. So, you know, with some complex data assets, we work alongside, you know, the real kind of data specialists, not valuers, but they kind of the ones who are trawling into the sort of consulting services and the architecture services and all of those. So, you know, when one does have a high value contentious sort of situation, one would probably want someone like that, and they would probably have the answer, but I don't. Nick, you might?
The only thing I would add to this is, in general, I would point out that the International Valuation Standards do provide some guidance as to how to integrate the integrate the findings of specialist organizations, and the kind of data specialists that you mentioned are very clearly those kind of organizations. So even the incorporation of those findings is covered by the IVS.
Fantastic. Well, thank you, everyone. These are great questions. And thank you, Nicolas and Tim, for this session. As mentioned at the start, today's session was recorded, and we'll share the replay link and slides with all the registrants. We also have other upcoming webinars as well, FAST30, linking patent portfolios to enterprise value, value-based brand strategy, and performance tracking, as well as tax implications of intangible asset value. So there is a series coming. It's first quarter of this year, so we're really very much looking forward to seeing you guys again. Thank you so much for your time, and thanks again for joining FAST30.
Thank you, everyone. Bye-bye.